What's going on, guys? Bexio back, and today we got a brand new video. Stocks are crashing and burning. Bitcoin on the same path, absolutely free falling, and all of crypto in free fall. It seems like we have just every financial market on the planet just collapsing right in front of our eyes, and not much we can do about it. But is the worst over? Is there more to come? What's the Fed doing? Why is all this happening? And there's some indicators we can look at to kind of point towards the future of what's maybe it gets a little bit worse from here. So before we get into that, if you're not subscribed, make sure you make your way over that sub button and smash it, because we are on the road to 1,000 subscribers. But let's jump into kind of some of this talks here. So obviously we know the stock market, it feels like it's in free fall, every single market, and that's because the Fed's interest rate hikes, those are something that is on the horizon that a lot of investors are worried about and thinking they are going to be a lot worse than what we might be expecting. So some of the red we're seeing, obviously pricing in those interest rate hikes being worse than expected, having more than I think it was 2 or 3 this year. That was the planned amount. Having more than that. There's some people saying we could have 7. That could be something being priced in. So basically, the worst of the worst is being priced in right now. That's just how the market works. It always wants to plan for the worst if things are going really bad, and kind of not have to get hit with news that it wasn't expecting. So that's just what the market has always done. So that's the federal side, the Federal Reserve side, the Jerome Powell. We might see like him saying this and saying he's going to do all these different things of tapering and quantitative easing or quantitative tightening and doing interest rate hikes and all this kinds of stuff. Seeing how the market's reacting, he's either got to decide whether to go through with it or to pull back a little bit. And he might be talking about doing all these things to start to get people's minds going away from, what was happening, and kind of get people to react away from what they were doing, which was causing bigger inflation, try to control inflation that way without needing to necessarily go through with rate hikes and this quantitative tightening, doing it very aggressively. But that's all up for interpretation if he does it or not. Some of these data points that are pretty interesting are these right here. This is the Google Trends data. So this is just something where you can look at to kind of see how the overall market or economy is doing. These are car loan and home loan. So we can see the blue line car loan, the red line home loan, and we see these fall off of a cliff since September, October-ish, just completely down bad, and they're below any kinds of averages for both of these. So the car loans are way lower than they've ever been in the past 5 years here. Same with home loans. This kind of tells us we could be seeing people not having a lot of money and people not having this wealth effect that we did have during last year and even 2020, with the stock market getting pumped up by the Fed, money printing going crazy, Bitcoin skyrocketing, crypto skyrocketing. People had a lot of money. You get the wealth effect, and that means that people feel like they can spend money, and then you get people buying cars, buying homes. A house is probably more of a financial kind of thought process than a car. But when you have a bunch of money, a new car, that's a lot of people would probably go to that first. So seeing this fall off a cliff could be telling us that we actually have people running out of money. We don't want to see that. That's bad for the economy as a whole. People don't have money, they can't go spend it. That affects the companies. They don't have the demand. They have to lay off employees or cut costs somehow, and then you get a big spiral effect of employees getting laid off, employees getting fired, jobs not being able to come by. You're not going to be able to find a job. You get into massive problems. You get into recession territory, which is something that a lot of people have been talking about. People like Elon Musk talking about a recession coming. So you get into those kinds of territories when you go down this road. And another kind of Google Trends chart here you can look at is this just overall kind of people's interest in the stock market. So this first one kind of looking at the overall economy, people's money maybe. If people have a lot of money, they're probably going out and buying cars, maybe buying houses. That might be a, a bigger financial kind of, you plan for that. But a car, for sure. People got a lot of money, you buy a car. You feel good about yourself. But the collapse here could be telling us that money is drying up quickly. Then they go just into the stock market, and I just throw Bitcoin in here because I think it's interesting to see Bitcoin interacting with all of these when you look at the levels. But Bitcoin's a severely retail driven asset up until basically this year or last year when the institutions started really coming in. But you can see, the blue line is stocks, kind of consistent here, going all the way up until 2020, where we had this first spike. A lot of people got stimulus checks, had to think about the stock market. The Fed saying they're pumping it up. A lot of people got into the stock market. You see another massive spike here with people obviously getting back into the stock market, meme stocks exploding, everything just kind of going crazy, and people got involved in it there. Got a lot of excitement, but ultimately it came back down basically to its mean around this 9-10 level area. We're literally right there right now. So people might be losing interest in the stock market. That would be bad for liquidity. Obviously, a lot more people in there, a lot more liquidity. We already had that with the Fed. You double on both of those, the Fed pulling out and retail pulling out. There's just not a lot of liquidity. That's where you get free fall prices. And the yellow line being Robinhood. This doesn't really matter at all except for recently, because Robinhood's the just main stock trading app that everyone knows and everyone goes to start. You see the spike and then the drastic fall off. A couple of spikes here, but they are all the way back down to 2, which is, the last 5 years is what they've hovered around. So Robinhood fell off. Just kind of looking at interest in the traditional markets and stocks and all this different types of stuff, the people and retail traders aren't really there anymore. So that is kind of mixed, where you could see that being a problem where more people aren't putting more money in, liquidity issues, whatever comes our way. But it could also be a good thing, kind of, the saying of if the shoe shiner is giving you stock tips, it's time to sell because that's the top. This would definitely probably be a bottom, with everyone leaving and saying stock market's a scam, all this different stuff. So it's probably a bottom, actually. But even with Bitcoin, just the kind of difference between Bitcoin, I think, is interesting, where you see this is 2017 bull run. You go into the bear market, going back to kind of its means, just like the stocks, just like Robinhood. And then we see it recently, these spikes where there's a lot of interest, obviously, but it didn't go down to where it was before. So this is like in the 20s is the level it's at now, compared to the 6, 7, maybe 6 to 10 where its mean was back here, and it's actually going up to like 20. It's in the 20s over here right now. So just kind of interesting to see Bitcoin. The interest in Bitcoin is staying there. Well, the interest in stocks is going down. The interest in Robinhood's going down. And this is just Google Trends. So, see what that means, if it means anything at all. But kind of just overall people searching for these things. People want to keep up with Bitcoin news. Maybe they're not as interested in the stocks news. There's more people pivoting to Bitcoin and crypto instead of the traditional markets. And I think that probably makes sense. A lot of people might have a more of a want to be in Bitcoin than a want to be in stocks. Even if we actually, let's add crypto here and just see if that's close to Bitcoin. So yeah, it's about the same path as Bitcoin. Kind of came up with it, and this other spike went back down. Another spike here, a little bit down. Not as much history between just crypto searching, so can't really look back on this. It's kind of like Robinhood. It's still up relative. It's still over stocks. So definitely think there's more interest in the crypto market and that kind of finances than there are in traditional stocks. So who knows if that really means anything. And the biggest thing that we got to keep our eyes on that could have a bigger effect on downward moves is margin. So right now we see this is kind of we don't have this month's stats, but you can see $798 billion because this is in millions. So it would be billions in margin accounts. So, money that people borrow from these brokerages to invest on their in whatever stocks they want. So we see this at almost 800 billion, and it goes all the way up, and we see it increase all the way to 910 billion dollars This 910 is way more than what we saw last or in 2020 December 2020, and we go back even more December 19, way more as well. And it's been pretty much skyrocketed. So the problem that this brings with it is if people, started their margin journey in March 2020, or even in this other spike, around this February, maybe even March of 2021, if they started their margin journey there and they were started investing, started using margin, and it was making money and it was great and we're doing so well. If we get down to those levels where people got in initially, then that margin all of a sudden turns into a massive problem where if you have $1,000 in margin and it goes under where you bought in, you still have to pay back that $1,000, but now you only have, say, $800 worth of stocks. So that's where you get even more problems where people start getting either margin called or forced to sell to pay off their margin. So hopefully we don't see that, but there's a lot of risk for this downside continued move. There's just a lot of factors, a lot of fear in the market, nothing really concrete here of any good news. Literally any good news is having a little rally where there's a bunch of sell-offs following it almost immediately. So the worst may not even be done yet. We might still be falling for quite a ways more, maybe even a few months up until these Fed's first meetings to see if they actually raise interest rates and what their plan actually is. We'll see Jerome Powell if he actually says, he's more dovish towards this, meaning he's not going to really attack it as hard as he once said he was, or if he's going to just ignore the market crying and just go after it, raising interest rates, can do the tapering, accelerate it all, and, go for maximum pain. So let's see what happens, but that's going to do it for this video. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. See you guys in my next video.